Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to the latest edition of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, this is episode 71, and we kicked around the title. We landed on Let the Good Times Roll. You a fan of that song? I mean, you like music.
Yes,
you like that song?
Oh, yeah. The one that's in my head is Fast Car right now. It's probably on half of America's heads now.
Wow.
But
yeah,
that was something else at the Grammys. Just watch Tracy Chapman come back and do that with Luke Combs. That was amazing.
yes.
Did you catch that?
Oh, I did. Yeah, I was sitting there. My daughter, of course, was cheering and screaming for Taylor Swift every second of the whole thing. But I did see that. Oh, by the way, I just saw, this just came out. We recorded this Tuesday morning. Toby Keith just passed away at 62. Did you see that yet?
No,
I know. I've been to his bar many times, the Toby Keith bar. Yeah, so that's only 62. So I'm not sure the details there, but that's yeah, exactly. But that's a shame, for sure. And so on the YouTube channel, let me just look down. You're still a tad orange. I don't know if you pulled out your Donald Trump for Halloween costume or what. And we're not sure why. Like if Sonu moves forward, he turns normal color, and he's far back, he's orange-ish. So I don't know.
I'm gonna blame my camera. Logitech. Whatever.
Exactly. But your voice sounds wonderful, and that's what really that's what the people want. We'll give the people what they want. So let's just kind of dive in again. Episode 71, Facts versus Feelings. Let the good times roll. We're going to touch on some regular themes around this podcast. Going to take a look at the stock market in February. Going to take a look at what the Fed had to say last year, and then take a look at really where the title of this comes from. The good times are rolling from the economic point of view. So, Sonu, first things first. Again, the stock market, literally on Friday hit all-time highs, right? I guess the thing that
number 7.
Yeah, honest to goodness, I'm not sure what number it is. I lose track. But yeah, it's around there. But I guess what gets me is if you look historically at seasonality in February. February's a weak-ish month. Yes, September is worse. But February's like number 2 across the board, especially in an election year. In an election year, this is the second worst month on average. Again, it's only so many election years back to 1950, down about 0.5%. But I've got it here in front of me. When you're up 20% the year before, February's have been really weak lately. Now, this is a sample size of 2, but entertain me here. In 2022, after a 20% gain, S&P lost over 3% in 22. And then, of course, 20 when COVID was, on the horizon, right, down 8.4%. But still, it just kind of, I think it kind of makes sense to me that, hey, this has been a heck of a run, right? We gained over 20% last year, 14% the last 2 months last year, another 3% or so to early this year, almost 4%, I guess. Wouldn't be shocked if we had a little well-deserved break or consolidation. And there are some factors of sentiment. Believe me, overall sentiment is still nowhere near major peaks. People day trading in hot tubs yet that I've seen. That's kind of where you see some major like 99. I remember 99. 99 was just 99. I remember that was crazy the way people acted back then. But nonetheless, what's your take on the idea of maybe some well-deserved break, which is perfectly normal, based on kind of some of the things we're seeing here?
Yeah, it looks, stocks can't just keep going up, right? I mean, what's positive? I'll put it this way. What's positive is we had the big run up in November and December. I think safe to say a lot of it happened in anticipation and after it's some signal of a Fed pivot, right? The Fed's going to cut interest rates sometime this year, right? And suddenly by the end of the year, I think the market's expected, if you look at market pricing for these things, markets expected the Fed to start cutting interest rates in March, right? It was 90% probability if you took that, right? So fast forward, where we are right now is the probability of a rate cut is 20%. In March, at least. The market's still expecting interest rate cuts this year, but they pushed that first rate cut timing out to May or June, right? So if you'd asked me at the beginning of the year, like given that, what would stocks do? I'd say maybe stocks would be slightly negative, considering the big run up. And so far, at least the S&P 500 is positive. The Dow is, I think, positive too. The Nasdaq's flying. I mean, so we have momentum there. Small cap stocks have struggled a little bit more, but even within small cap and mid cap stocks, you look at things like mid-cap industrials, right? They've been doing well. I mean, if you think the economy is doing well, the cyclical areas of the economy is what you want to see go up. And we're kind of seeing pieces of that. So, I think all's well so far.
Good point. Now, I will say last week I was on the road. Remember, I think we mentioned it was National Meat Week, and I was in the great state of Texas, and I ate just a good amount of barbecue. I'm a big Hard 8 fan there, and I guess it's all over Texas. I went to the one in, where was I? Roanoke, which is just in Dallas, Fort Worth. It was wonderful. Not even sure where I'm going with this other than to say I celebrated Meat Week. How did you celebrate Meat Week, Sonu?
I think I was with the kids, and when I'm with the kids, I think I mentioned it that they like, so I'm in Chicago. I love hot dogs, right? And I like a nice Polish or Italian sausage, things like that. And the kids will have none of that. They want Hebrew National or Nathan's or something. It's like, oh my God, that's what I have to do. And then I have to slather ketchup all over it. It's like, ugh, like, don't have ketchup with your hot dogs, people.
No, that's
at some point I have to tell my kids that. I don't know what age I need to break it to them that you're not allowed to have ketchup with hot dogs anymore.
Well, that's true. We'll get there. But here's what I was going to say. I was running around Texas, and it turned out one of those days last week, I forget the exact day, we had some more regional bank crisis. That's a strong way to put it. Some regional bank worries flare up with New York Community Bank, I believe was who it was. Their stock was down over 40% one day. Lots of potential issues. So regional banks were weak again last week, and that played some of it. But like you mentioned, there are parts of small cap and honestly mid cap that are still hanging in there quite well. Let's see here. What else did I want to talk about? So February, so goes January, goes the year. I know we touched on this last week, but when you have a down January, the rest of the year, 11 of months are up about 2% average, higher 60% of the time, versus if you're positive in January, like we just were, the next 11 months are up like 12% on average and higher like 85% of the time. Now your average year gains about 8% or so, is about 3 out of every 4 times. So just some things to think about that, just the fact we got that that good start, and even though we were down in the Santa Claus rally, we were down the first 5 days of the year, we looked into it. It really matters, I think, a little bit more for how January goes. So, and one other thing, I've talked a lot about this, the first quarter of an election year, the first quarter of a year after you gain 20%, it's not like you have a bear market, I'll be very clear, but big gains aren't so normal. Most of the gains in an election year happen later in the year. So all these things kind of stack up for potentially a little, and again, the market's high, but a lot of stocks have been underperforming, honestly. There's a lot less stocks above their 50-day, above their 200-day moving average. This isn't end of world stuff. It's just some signs, maybe there's some little bit of weakness under the surface, and some potential indices pulling back in February would be perfectly normal. I want to point that out. So anything else you want to talk about? Because I know we want to talk about the Super Bowl for a minute here. The wildly popular Super Bowl indicator.
No, just going to, on the topic of elections. So elections is a positive, right? So, and one thing that struck me was that there's actually, speaking of elections and what politicians do to get reelected, there's actually a tax bill moving through Congress right now, and it's bipartisan. I mean, you think about this age of like everyone's at each other's throats. It's actually a bipartisan tax bill, and of course, tax bill means everyone wants to cut taxes, right? And this one includes like business research and development type write-offs, and we can dig into it. I'll in a blog or something more. But
it sounds exquisite. I mean, that just sounds so exciting. So
but
exciting.
It's more money. It's more money in the economy from the government, right? I mean, that's if businesses don't have to give that much more to the government. Same thing. There are child tax credits also going up, so that be more money in people's pockets. Guess what? It's an election year. This is the sort of thing that happens, and it happens in a bipartisan way. That, going back to your point about election years tend to be positive. Well, maybe there's a reason why.
Well said. We talked before, but I think it's important to remind the listeners, the last 10 times we had an election year with a president up for re-election, take a wild guess. Yes, the S&P 500 was higher, about 12% on average, not like wildly strong, but hey, 10 out of 10, low double-digit returns. That's not too bad. So, Sonu, this week is Super Bowl week.
Right.
Now, before we even go there, what division are the 49ers in?
Ouch, I knew you would ask me that. I looked it up. NFC. Oh my
You
God, I
looked
hope
it
it's
up.
NFC. I hope
One of
it's
these days, I hope you don't have to look it up, Sonu. So that means the Chiefs are in the what? Which one are the Chiefs in? This is
good.
like double jeopardy here.
I know it's AFC, but please, for the
There you
life
go.
of
It's AFC.
for the life of me, do not ask me to expand those acronyms.
Okay. We'll leave it at that. We'll leave it. Okay. So Sonu has learned in 2024. Sonu has learned something. That the 49ers. Yeah.
What
go
is
ahead,
AFC? American Football?
American Football Conference, technically, but honestly, and the
okay.
National Football Conference. But nobody really.
Got it.
It's just kind of, I don't know. You don't really point that out. It's the AFC. So, and we took a look at the Super Bowl indicator, and the way that we looked at it was, historically, if you have an old school NFC team, think the Chicago Bears or Green Bay Packers, teams have been around forever. The market did better on a relative basis, but we just took a look at, made it simple. If it's an NFC team that won or AFC team that won, when the NFC wins, Sonu, the S&P is up 10% on average versus AFC about 7.5% on average. 76% of the time higher for the year on the S&P if the NFC wins versus AFC about 68% of the time. So that's fine. But I one thing that I thought was fascinating, I did this last year, and I never heard anyone look at it like this before, but we got some press in the media with it, was when there's blowouts or close games, it turns out that's what everyone should be rooting for. Because, where is this? There it is. There's Super Bowl spread. Here it is. I've got this sheet in front of me here. When the winning team wins by 21 points or more, which is 3 touchdowns or more, the median returns almost 15% higher, 85% of the time for the S&P. If it's a single-digit win, the average is like 6% higher, 60% of the time, and right in the middle is a double-digit win. You've got about 11% average return and 80%. Believe me, do not ever invest in anything that I am pointing out or talking about. But I thought it was kind of interesting because what struck me on this one was a couple years ago, my Cincinnati Bengals made the Super Bowl, lost in a very controversial game. Just go look at some of the holds, some missed calls. Not that I'm biased or anything, but I think that should have an asterisk next to the LA Rams victory there. But
actually,
anyway,
I have, as somebody who doesn't follow this stuff closely, like I couldn't even name who was in last year's Super Bowl, so let's not go there. But given last year's return for the S&P 500 was 26%, is it safe to conclude that the Super Bowl was a blowout last year?
No, it was actually a close one. So this
it was a close one.
It was the Eagles and I guess Kansas City, right? So yeah, and that was the joke I made. When the city of brotherly love wins a championship, really bad things happen, like financial crisis, and you're talking tech bubbles, and you're talking all types of bad. And our friends in the city of brotherly love just love that. But what struck me on this was the Bengals lost a close game, and the market was killed back in 2022. So anyway, so that's some things. Now, last thing on this, because believe me, I know this is silly, but we're going to do it anyway because people like this stuff. Kansas City's won 3 Super Bowls on average. The market's gained 13.5%. That ranks 7th out of all 21 teams. I think it's 22 Super Bowl winners. And then the other one's the Niners. The Niners have won 5 Super Bowls. Wow. If they win this time, that's 6. Obviously, like the way I did that. That's how smart I am. It's 6 if they win another one. The Steelers have 6, and the Patriots have 6. They tie them. But here's what's really interesting: they've won 5. Okay, the average return is 19.2% for the S&P when the 49ers win. So either way, I think we'll be in good shape. But I'll just go on record. We know
who we're rooting for.
Well, yeah, as a Bengal fan, the Chiefs, I don't know. We don't like them very much. But I'll say the 49ers actually have a couple Ohio State guys. I'm an Ohio boy, so I'll say 49ers. In a close game. We'll see. I think they got a better defensive line, offensive line, but they don't have Patrick Mahomes or Taylor Swift for that matter. So that might matter a little more.
So you brought up an interesting bit of trivia. I caught on to that. You said NFC has all the old school teams. So not to keep talking about football, but I'm just curious. So was the NFC originally that's what started it all?
That's what it all. Team? Yeah, and I think I guess we can do the math on this. I mean, whenever the Super Bowl started, but then they merged with the AFC and that created the two, and they just kind of played each other. And the NFC won the first several Super Bowls because they were kind of the established teams. But now it's believe me.
So it's nothing to do with East Coast, West Coast, Midwest, nothing like that. It's just like
not that I know of. Now a lot of those original NFC teams are kind of in the Midwest, to a degree, where they were. But then they started branching out. But that's at least the way I understand it, the way it was taught to me. So
learn something new every day.
Yeah, exactly. So, and if you want to bring up some silly data like this, feel free and ask us to do some studies. Feel free and email us. Facts versus feelings. Versus is VS at carsongroup.com. We've got some emails and things there. And I will say some people have asked about Mabel, my dog, who 2 weeks ago today, she was spayed 2 weeks ago today. And the reason we're doing this a little early, not that this matters to anyone listening, we're doing this podcast podcast a tad early on Tuesday. I need to take her to go get her staples out because my wife's running around doing some things.
Ow.
And once she gets her staples out, she's fine. She's running around like a crazy person. Then she can finally go back to daycare. This dog is nuts. I mean, she hadn't gone to daycare in 2 weeks, Sonu. She's back to normal.
Wow.
And for everyone's sake, this dog needs to go to daycare. And hopefully in about 2 hours, we get the staples out, and I am taking her straight to daycare so she can play with some old friends there. Also, my son twisted his ankle yesterday. Sebastian was playing basketball at recess. Yeah, and he jumped up, and big kid, he just fell funny, and it popped, and I immediately took him to we got a nice walk-in orthopedic place. Unfortunately, I feel like I go there often. And we went there 3 times for football last year. Basketball's over this next week. I was like, oh, we almost made it without an injury. He twisted his ankle pretty good. So I don't know. Next week's a tournament, so I don't know if he's going to be playing or not, which is a shame. But I guess that's just
to him.
Yeah, that's just
Fingers crossed for him.
Yeah, that's just the way stuff goes. All right, so Sonu, let's start talking about the Fed here in a minute. Anything else on the stock market before we get into the Fed?
No, I guess, just keep it churning. I mean, I guess so February is likely to be a little volatile, take a breather, and then hopefully we're off to the races, if I can say that after that.
Yeah,
but
I mean, I shared it on X, Twitter, but there's something called the Carson cycle composite. Looks at the average year and the fourth year of the presidential cycle. And I just added when January's higher after a 20% gain. I've got all these different things that a proprietary indicator I smushed together. And that Carson cycle composite was wildly accurate last year. Like the year almost played out to a T, honestly. So believe me, you wouldn't just blindly invest in this. But what that says is be open to some choppiness until late March, from right now to late March. And again, it doesn't mean it's going to happen. But again, that's the way some of these cycles work. And I've written about that before. I'll talk about it some more. But the Carson cycle composite, I'd say, would be more neutral. Let's say for the next 6, 7. Let's get through March Madness, and then maybe turn a little more optimistic. But that's not the end of the world after the rally that we've had. So Sonu, the Fed, I guess there's 2 ways to look at this. Jerome Powell was on 60 Minutes on Sunday. No one watched it because we all were watching the Grammys. But he also was in the spotlight on Wednesday. He kind of said about the same thing. I mean, I guess by the way, the 60-minute interview I heard was on Thursday before the jobs number, but some of the words and lingo he used, I think it's safe to say he knew what that jobs number would be when we're talking about jobs next. I think, he should. Honestly, he should. He's supposed to know this stuff. Which one are you going to talk about? 60 Minutes or Wednesday, or just smush them together? What do you want to talk about?
We'll smush them together. And I hear it was his birthday too. Was it Sunday? Was his birthday?
That's right. Yes, his birthday, because he took over the Fed on the 5th, and his birthday's on the 4th. So how about that?
Okay. Okay. Well, happy birthday to Chair Powell. No, look, he came in and basically squashed expectations. I think that's a good way to put it. That they would start cutting rates in March, right? So, but he did say, look, the 60 Minutes was notable because it was kind of the same thing. What he said during the press conference after the FOMC meeting, the Fed meeting on last Wednesday. He said, look, we are very happy with how, what's happening with inflation right now, right? In terms of it's coming down, but we want to see more of the same, right? We don't necessarily want to see better numbers because, look, core inflation by their own preferred metric, the personal consumption expenditures index, that's running at 1.5%. Over the last 3 months, 1.9% last 6 months, right? So it's below target. Like, it doesn't need to get better than that, which is what he said. But they want to see maybe another, he didn't specify a time period, but I think maybe another 3 months, maybe 4 months. But that gets us to May, right? And every single indicator we look at, I mean, I mentioned this last week on the podcast as well, it tells us that inflation's likely to remain on the lower side, which is why the market's expecting rate cuts, right? So I think the Fed just needs to have what, quote unquote, even they mentioned in this statement, greater confidence that inflation's actually heading back to target. And coming back to the 60 Minutes interview, one thing he mentioned, I think he's said this several times in the past, but it's always good to remember, they don't need inflation to be at 2% to cut, right? That's important. So inflation could be like 2.4%, and they can start cutting rates. It doesn't need to be at 2% to cut. So I think that's positive. That means rate cuts are coming. It's just a matter of, I think, I think we've talked about it, that I've always been in the camp that maybe the first cut will be May as opposed to March. And I'm still in the camp that maybe we see about 4 rate cuts. So that totals up to 1 percentage point. So 5.5% to 4.5%, maybe by the end of this year. I think markets at the beginning of the year were pricing in 6 to 7 cuts. So about 1.5, 1.75%. That's come down to about 1.2, 1.3% right now. So markets are expecting about 5 cuts of 0.25% each this year. So I think it's still a little on the, higher side. But, given, I should say, all this is conditioned, our expectations, my expectations, it's conditioned on the fact that we won't go into a recession. There's no sign of that right now.
Yeah, and you've been, I don't know, pushing back is the right way to put it, but you've been saying March might be a little early, a tad early, and that apparently is how things are looking. With Jerome Powell, he took over the Fed on February 5th. I get choked up. I always get choked up talking about the Fed. Excuse me. Jerome Powell took over the Fed on February 5th, 2018. Okay, the only reason I remember that was because the Dow dropped 4.6% that day, S&P down close to 4%. Wow. That was his first day. And you think about a bad first day on the job. That's a bad first day on the job. It was because that was the day that the China, the tariffs, U.S.-China trade war.
Yes.
The trade war technically started that day, and the market was lit up pretty hard. But it was also Jerome Powell's first day. So I joke about, the 16 different Fed chairpersons. I looked, and that was by far the worst first day ever. Using the Dow data, we've got Dow data back to 1896, so we use the Dow on this one. Now, I will say this, Sonu, out of the 16 Fed chairpersons, Jerome Powell has seen the Dow gain 51%, which is 1, 2, 3, 4, 5, 6. So only 6 better. Do you know who saw the largest Dow gains while in charge of the Fed? You want to take a guess? You've heard of them. I'll just say that much. You want to take a guess?
Only because I know that he spent the longest time being chair. I'm guessing Greenspan.
Yeah, it was Greenspan, 312% on the Dow. Now, actually, interesting tidbit for the listeners, because if you didn't know it, maybe the listeners don't. William McChesney Martin Jr. was in charge for 19 years. He was in charge of the Fed longer than anyone. Believe me, Greenspan was up there. That's my Jeopardy question for the day. And under him, it gained 199%. Under this one surprised me a little bit. Volcker, because I always think about Paul Volcker, inflation, the 70s, rough times. Hey, the Dow gained 212% under Paul Volcker's leadership. And I've said for a long time, you think about the greatest handoffs in history. I don't know, you can list some, but I think it was in Paul Volcker in August of 87, after that huge run up, things where he said, you know what? I'm out. Greenspan, you're because he probably knew. Right. He knew, hey, listen, up 500% from the 82 lows, up 41% or something year to date in August. He probably said, I'm out of here. And then Greenspan came in. And anyway, so there's a little trivia for you, but obviously doing well on an annualized basis. I think it's interesting on an annualized basis. 7.2% for Jerome Powell. Janet Yellen. They're old Janet Yellen, didn't rock the boat. I think did a great job. Annualized up 12.9% as I glance at this.
And that's above average, right?
Oh,
average
my goodness gracious. Yeah, I don't know.
9%.
Yeah, that's well above. And that's I'll just glance into this. That's like third or fourth best on an annualized basis. And poor Eugene Meyer. Annualized basis. Well, you don't want to do too many years like this. Annualized 32.6%. He was the unfortunate gentleman to be in charge of the Fed during the Great Depression. So that'd be a really rough time to be in charge of the Fed. So there's your Fed, Fed trivia for the day. So let's talk a little more. So why does this matter, Sonu? Why does rate cuts in March, rate cuts in May? I mean, how does it all come full circle to the listeners from a portfolio point of view?
I think from just getting to why interest rates matter, right? Because a lot of borrowing is keyed off of interest rates. And, and one big reason is, just say, where do interest rates have their most immediate and largest impact? I think it's housing, markets rates, right?
Yep.
And we saw as soon as the Fed, I always thought that Fed policy, whether they're raising rates or loosening rates, whatever the case may be, always works through housing. Right. Historically, I've always been in that camp. But that's where you see the immediate impact of it. And that's why, the Fed raises rates, housing goes down. We saw the same thing play out in 2022 into 2023. But this time it was not, it wasn't a credit driven cycle. You and I have talked about this. It was because it's been an income driven cycle. People are getting a lot more people are getting employed. The labor market is strong. We're going to talk about that. And that's what's driving the economy, as opposed to people taking on debt, whether mortgage debt or businesses taking on debt to invest either, right? So I think we're in a different place right now. So rate hikes haven't had that big of an impact, but I think rate cuts will be good at the margin.
Yeah, no, well said. I want to dive in there because that's interesting what you said, because we have pointed this out. This is an income-driven cycle, meaning, hey, people are making more money. People are incomes, wages are growing faster than inflation. So real incomes, real wages, like hitting like all-time highs. And we talked about that 12 months ago, why it was positive. And here we are a year later, and we're still in that camp. But you mentioned, an income-driven cycle versus a credit-driven cycle. Can you give the listeners an example? Was like, when was the last credit-driven cycle? Was that like up until the Great Financial Crisis when everything fell apart, or was that the 80s, or when was a credit-driven cycle versus income-driven?
I would say the last 3 cycles before the 2010 to 2019, right?
Okay.
2007, the 2000s was a classic credit-driven cycle because, the housing bubble was running on credit, right? I mean, I would argue that even if you look outside the world, outside the US, not outside the world. I mean, I'm not talking about Mars here, right? Maybe Elon Musk will talk about it. Now, outside the US, like China, I think is a classic credit-driven economy here, right? A lot of how investment spending over there is done on the back of debt. Right now, if you go back to the late 90s, I think was also partly credit driven because you had a lot of business investment. Now, business investment is good. I'm not saying that's a bad thing. That's what gave rise to a lot of productivity, but it was a credit driven cycle. Right. And then even before the 91 crisis, you had SNLs, all of that, remember, savings and loans. So that was also a credit driven cycle. The last time when you didn't have that was, 50s and 60s. I think those are classic income driven cycles. Right. For the last 3 years. Now, 2010 to 2019 is a little different because, after the housing bubble crashed, we've talked about this, people's net worth went down. Right. Housing. For most people, housing is the biggest source of, your net worth. But as you get higher up the income spectrum, then stocks become a big part of that. But stocks and housing crashed. Home prices crashed after 2008, right? So, and it took so long for that to come back up. Stocks are back at their all-time highs, I think, by you probably know better.
2013.
2013, right? Thank you. And home prices are back. It took even longer for that. So what everyone is doing is deleveraging. Corporations deleveraged. Households deleverage. So last cycle is really a deleveraging cycle, which is why economic growth is really slow, right? Nobody's spending. Everyone's like, I need to increase savings because I just got completely smacked in terms of my net worth, right? And that's what we saw last decade. We're out of that now, safe to say, right? Now it's an income-driven cycle. I mean, you look at total income across the economy, right? That's growing at above 5%, right? That's nominal GDP for you in a sense, right? Where does GDP come from? It comes from that's consumption that comes from incomes. Incomes growing about 5%. That's where profits and revenues for companies also come from, by the way, right? So, and you look at how is aggregate income created, right? Employment growth plus wage growth plus hours worked, right? You take weekly, average hourly earnings, multiply that by, weekly hours worked. Weekly hours has been, going down. Last month, we could talk about it, was especially low, but I think that was because the BLS told us, the Bureau of Labor Statistics told us that hours worked was low because the survey week was during when it was negative 25 degrees across a lot of the country, right? So a lot of people had jobs, but they didn't go to work because it was too cold, right? But then you look at a big driver is actually employment growth. You think about employment growth versus wage growth, right? If I get a raise, yes, that's great. But maybe I save part of it. Maybe I pay off some debt, whatever it is, right? It doesn't all translate to higher consumption. Whereas if you take employment growth, when you take somebody going from unemployed to employed, that is a big increase, especially in terms of consumption. Suddenly, it's a lot more income coming into the economy. That's basically, I think, the story of the economy right now.
No, that was great. I mean, I think that was, I don't remember what question I asked you. I have no idea what I asked you, but you were on a roll there, and I was not going to slow you down. Somehow we're talking about the Fed, and we just got on it was the income-driven cycle. Anyway, that was awesome. I mean, so I think we'll take a break there, and we're going to definitely focus on some of the things you just talked about. But I will say right now, let me make sure I read this correctly. Help us out by telling us how we're doing. Leave a review. Use the thumb buttons. And subscribe if you want to hear the latest. So definitely thanks to all the listeners out there. We've hit 50,000 downloads of this podcast. As we continue to grow, you can continue to help us by doing what I just asked there. We really appreciate it. Sonu, Leap Day's coming up. We get a Leap Day every 4 years.
Extra day.
Extra day. How are you going to spend it this year? What are you going to do?
I'm going to make an extra special day for everyone here. But I'm going to spend it with you. And we have some amazing guests. I'm really stoked about this. I'm thinking of what questions to ask of these people. We're going to talk about everything, right? Technology, stocks, and AI, and Bitcoin, and elections, and All of it.
Yeah, it's income-driven cycles, credit-driven cycles.
Income-driven
It's all in there. It's all in there. But this coming Leap Day, and you can check it out. You can go to carsongroup.com/Leap Day, and you can sign up right there on LinkedIn. We're going to do this a live Facts versus Feelings on Leap Day. I think we call it Leap Day Live with Facts versus Feelings. It'll be a lot of fun. We've got 4 different guests, and I don't know if we're allowed to say who we have yet, but if you go to that LinkedIn page, we list a couple of them, so I'll just leave it at that. But there are some big names. There's a couple more. Gee, I don't know. Have we heard about the other couple guests yet? Have you heard anything yet, Sonu? We've got some on the
you're taking on the people hook. Into how the sausage is made behind the scenes over here.
Yeah, it's interesting. But we're going to have hopefully 3 or 4 guests, and they're going to be awesome. The couple we've got already, you've heard of them. I promise you there. And it's going to be really cool. So it'll be a live, 3-4 hours. We're working on all the details. Just leave Leap Day afternoon open is all we can say there.
Somewhere between 10 o'clock Central to 2 o'clock Central time. 11 o'clock Eastern, 3 o'clock, somewhere around there.
Yep,
so just
somewhere
keep
around
that
there.
Space.
Just get ready to order some DoorDash. Let them bring the food to you. You don't want to leave your desk or your phone or your laptop. All right, so Sonu, let's wrap things up here. How are we doing time wise? We got 10 minutes maybe, give or take.
We got about 10 minutes.
Sonu's got a hard stop. Got to get the kids on the. What do you do? You got the kids on the bus. What do you have to do exactly? Is that what it is?
No, I drive them to school. I usually bike. I knew that. We usually bike to school, but it's cold. So we drive. It's a 2-minute drive, but they have to get there.
They're supposed to go. That's a very good point. And for your own sanity, you kind of need to get them out of the house once in a while. I know that. I know that. My daughter's 16. Mentioned her before, Susanna. She's been driving for 5 or 6 weeks, and knock on wood, everything's been smooth. And yes, my insurance was from $2,100 to $4,600. That's how it went, right?
Wow.
And I'm like, wow, that's a lot of money. But a couple friends of mine said, listen, you don't understand, though. Yeah, that's a lot of money. I'm not minimizing it. But they said, hey, the time it saves you, and I'm telling you, Sonu, it's worth it. It's worth it. I mean, I get to sleep in a little more. I used to drive her to school. She's taking herself to practices. We used to practice till 9:30 at night. My wife and I would argue over who had to go get her. I did it last time. Anyway, but you don't do that anymore. So yeah, it's more money, but oh my goodness, the freedom and the time it gives back. Now, I will admit, I love taking her to school. She usually just yelled at me for whatever I did wrong. Because believe me, if you have a 16-year-old girl, you know what I'm getting at. You can do nothing right. But we'd listen to Taylor Swift and stuff. So I miss that. But I'll tell you, there are some positives. There are some positives as well. Speaking of positives, let's bring this home. This is episode 71 of Carson's Facts versus Feelings. Let the good times roll. So there are 3 things we really wanted to focus on. You kind of hinted at some of them already. Jobs, productivity, maybe look at AI as well, and consumer confidence. Who knows? We might go a little more, but those are the 3 big things that happened last week. Let's start with jobs. 383,000 jobs created, more than expected, almost double what was expected. 353. You know what? I was talking about the revision. I already know. See, it's in here. I know about the revision that's coming. I didn't tell you, but now I let the cat out of the bag. Anyway, but the prior months were revised higher. Unemployment, once again, below 4%. It looked like a perfect number, but here's what I want to focus on for the listeners. What I heard was kind of what you hinted at. People said, well, if you look at the household survey, we lost jobs. Well, all the jobs created were from the government. Well, hours worked actually went down. So there are some, people, I don't know if they're armchair economists or not, but poking holes in this, what seemed like a positive jobs report. You want to kind of go full circle on some of the maybe errors of people's ways, or what do you think about it? Was it as weak as they said, as strong as they said, maybe in the middle? Take it away, Sonu.
It was strong, period. No 2 ways about that, right? Now, before this report, there's always noise. There's always something to poke holes about. I mean, a lot of noise about, every month's been revised lower, right, for the last several months, which is true, but it's still strong. The underlying thing is, yes, it's been revised slower, but job growth is averaging, about 180, 190,000, something like that. But now we got 353,000 jobs in January. And December was revised up, not down, from 216,000 to 333,000. Massive increase. All of 2023 was revised up from 2.7 million to 3 million jobs. So we have some solid momentum coming into this year, right? The 3-month average, monthly job growth is about 289,000. That's the highest in 10 months. Right. So, and then you look, then people say, what about, full-time jobs, part-time jobs? So that part, so the numbers I quoted comes from something called the establishment survey. The BLS survey is about 150,000, establishment businesses, basically. Right. And The household survey is where the unemployment rate comes from. They also measure, how many people are employed, but that's a smaller survey. It's still large relative to some other private surveys. Private surveys like PMI's 300 large manufacturers. The household survey is like 50,000 something. So it's large, but still it's smaller, right? And it's much more noisy. And that's why usually from that report, you want to take away ratios. That's like the employment population ratio or the unemployment rate. Unemployment rate stayed steady, unchanged, near 50 plus year highs of 3.7%. The employment population ratio, which is, I like to look at that. Prime age employment population ratio went up 80.4 to 80.6%. 80.6% is the highest it ever got to between 2001 and 2019, right? For women, it's at 75.1%. We've never been at that except last October and September, right? That's when it hit a record of 75.3%. Now it's 75.1. So this is a huge, those are massive numbers, right? And then you look at, full-time, part-time employment. Like, look at all the part-time jobs. You hear a lot of that. That's coming from that more noisy survey. So I would take that with a grain of salt. Those things are very volatile. Full-time employment is actually, if you look at full-time employment as percent of the labor force, I don't have an exact number, but it's pretty much where it was pre-pandemic, right? So it's not something I would worry about. Then he's like, all the job gains are in government. I was like, oh my God. But it's almost like, wait, don't cops, firefighters, teachers spend money? I mean, I don't get that piece of it, right? Like, so what, right? But okay, forget that. Healthcare is also, a defensive sector. People are like, all the jobs are coming from healthcare. Yes, healthcare was up 100,000 in terms of jobs created in January. But then you look at some of the cyclical sectors, professional business services, that was up 74,000. Then you take really cyclical areas, construction up 11,000 in January, plus 50,000 over the last 3 months. Manufacturing, by the way, everyone's like, manufacturing is in a recession. Right. 23,000 jobs created in January. 56,000 over the last 3 months. That's not recessionary by any stretch of the imagination. So hopefully that puts some holes in the holes, Ryan.
Exactly. I think you did. I think you're popping holes all over the place here. Well, my notes also: construction up 11,000 jobs. The last 6 months up 116,000, and like you said, manufacturing up 56,000 in the last 3 months. Yet we continue to see these. Even we had the ISM manufacturing late last week came in stronger, up over 49, but still below 50. And believe me, I mean, there's some very well-known economists, who I'm talking about out there. They're very well-known bears, and they were just last week talking about, it's still beneath 50. It's like, yeah, but new orders are surging, and there are some other things besides just simply following a survey. But I love when you pointed that out. Those PMI surveys for manufacturers are like 300, right? 300 versus hundreds of thousands of sample size if you look at the hard data from the government. Let me see if there's anything else here on. So the household survey was down 31,000, down 3 of the last 4. Versus, again, we're seeing some significant gains. Now, when I took a look, there were some months, previous where we're kind of flip-flop, where the household survey was up a lot, and the other, and the monthly one wasn't up as much. So does this just even out over time? I mean, again, some relatively well-esteemed economists keep saying, look at the household survey, it's telling you something different. And you're just saying maybe it evens out over time and it's volatile. Is that kind of where we stand on this?
If I had to pick, you're always looking for corroboration, right? Across different, from the establishment survey, pick non-farm payrolls and pick a 3-month average, because the 1 month is likely to get revised. So that's why I use the 3 month, right? And from the household survey, I would pick, your best, at the end of the day, one of the best indicators is on the unemployment rate, right? Yeah. But if you want to go one step beyond that, I really like the prime age employment population ratio. That's at 80.6. That's eased off a little bit from the middle of last year. It was like 80.9%, but that's still pretty good, 80.6%. And then you look at layoffs, right? Layoffs every month are running about 1.5 million right now, right? It's crazy to think like 1.5 million people, get laid off every month, right? But before the pandemic, that was about 1.8 million. So, and then we have a bigger labor force now. We have a bigger workforce. So if you take the layoffs as a percent of the workforce, that's running about 1%. Versus 1.2, 1.3% before the pandemic, right? And then you mentioned consumer confidence. Hey, if you don't believe any of that, maybe you look at consumer confidence. Consumers also saying that the labor market is good, right? The Conference Board has a consumer confidence survey that went up a lot in January. It was a huge 2 month, 1 month, even 1 month increase. But they asked people about the job market, right? And the percent of respondents saying jobs are plentiful. Right. That rose 5.1 percentage points to 45.5. The percent of respondents saying jobs are hard to get fell 3.3% to 9.8, right? So the difference between the two is something called the labor differential index. That jumped the largest amount in the history of this index, 8.4 percentage points to 35.7. Wow. In 2019, that was 33.3. So even consumers, all this to say, consumers are saying this is a really good labor market.
Well, no, well said. So we talked about the jobs. We talked about consumer confidence. Just a couple more comments on consumer confidence. The monthly consumer confidence from the Conference Board up 6.8 to 114.8, highest since December 21. Present situation index saw its largest gain in 3 years. Okay, wow. So we're seeing some things there. Our friends at Bespoke noted when you see a 2-year high in the Conference Board consumer confidence and the Michigan consumer confidence, which comes out something like weekly, but is that monthly? The Michigan one?
That's monthly. It's monthly.
Okay,
they give 2 reports a month. One is a preliminary flash estimate.
Okay. Well, okay. So nonetheless, when you hit a 2-year high in those two well-known consumer confidence, my personal take is, okay, everyone was bearish a year and a half ago. Everybody said recession. That was a great time to be a buyer. We talked on this very podcast repeatedly about that. But now we're starting to see, things are pretty good. People are realizing it. According to our friends at Bespoke, thankfully, they noted when you hit a 2-year high on both of those the same month, happened 19 times since 1980. They looked at the 6 times since the GFC. S&P higher a year later, all 6 times, up 12% on average. So not a major warning sign. And again, you mentioned the jobs plentiful of 5.1% to 45.5, a big jump. So, hey, listen, maybe people are saying one thing, doing another, doing one thing, saying another. You can poke holes on these things when you take a closer look. I think the consumer confidence coming back and the job market is in a much better shape than a lot of those economists told us on Friday, even after that strong data. So let's finish things up, Sonu. I know you got to get the kids going here in a couple minutes.
Yep.
Productivity. We saw some very strong productivity numbers again. 3 quarters in a row of above 3% productivity. You've been talking about productivity for several quarters here in our team. Talking about, listen, the key to this whole thing, the key to all of it is stronger productivity. If we get stronger productivity, we can have some really positive things happen. Hopefully this isn't something new to longtime listeners, but in a couple minutes or as long as you want before you have to jump off and take the kids to school and be productive so your wife doesn't yell at you. What'd you see in that productivity number?
No, I think it's nice that when data corroborates, the story like we've been telling, right? It was a story, big part of a 2024 Outlook story. So hopefully all of you have downloaded the Outlook by now. If you just go to carsongroup.com/Outlook, you can download the Outlook. So that should get you there. But look, Q4, fourth quarter productivity came in at 3.2%. People are expecting 2.1%, which by itself would have been good. From 2005, 2019, we averaged about 1.5%. So even 2% is above that. That's positive. We came in at 3.2, right? Now, quarterly data is volatile. That's why you want to expand the horizon a little bit. Last 3 quarters, productivity is running at 3.9% annualized. That's massive. That's huge. There's no 2 ways about it. It's the largest non-recessionary rise since the late 90s. I mean, as you've said before, during a recession, it looks like productivity goes up. That's because everyone who's employed has to work harder to make up for the people who've been laid off, right? So in 2023, productivity rose 2.7%, which is why you had GDP growth running above trend even as inflation fell. So that's the story of the economy right there. Why is GDP growth running strong, but inflation falling? Because of productivity, right? And then the nice thing about productivity is, look, wage growth is at productivity plus inflation, right? In the 70s, what did we have? We had low productivity. So when you had strong wage growth, you got a lot of inflation. Now, in the 90s, it was the opposite, right? You had a lot of productivity. So even if you had a lot strong wage growth, people are getting paid a lot, salary increased, all of that. But that didn't translate to inflation because productivity was high, right? And I think we could be in a similar place right now. The nice thing is, what's driving productivity? I think it's a tight labor market, right? It's a fruit, essentially, of massive hiring in 2021, 2022. Now, when you hire someone, as all of us know, you don't get them to be immediately productive, right? And they have to be trained, and past hires have to be maybe retrained as well, right? But now I think 2023 was a time when all of that came to bear, and like all the training, like businesses put a lot of money into training and hiring and all of that, right? So hiring is actually eased. Companies, I think, are hoarding labor. By the way, that's probably why layoffs are running low. And, people are quitting less, right? So there's less churn in the workforce. And so the workforce is getting more productive. And then you had supply chain improvements. You had private investment. I think I talked about it last week. Manufacturing construction, right? Thanks to CHIPS Act, IRA, all of that. Manufacturing construction is just 0.5% of GDP, but it contributed like close to 10% of the GDP growth we saw last year, right? And then you think, what about AI, right? So here's a glass half full look with AI. or maybe even more. So what the productivity gains right now that we are seeing, as I mentioned, I think it's because of the labor market, tight labor market that leads to business investment, and that's positive. That's what you need for for productivity increases. Now, AI is not showing up in the data yet. In fact, investment in technological equipment, right? Computers, semiconductors, things like that, that's actually running below trend. The good news is it actually picked up in Q4, right? So I think that is coming. It's not there yet. But the good news is we've already got productivity increasing because of a tight labor market. And what does that allow? It allows the Fed to ease rates a little bit because there's less inflation, right? And then if rates go down, business are like, wait, rates are lower, so we can invest more. Now we buy more technological improvements, all of that, equipment, things like that. We invest in AI, and you get more productivity. And then we are in this nice feedback loop where things are going, the wheel's turning in the right direction.
Yeah, exactly. Again, the last time we saw something similar to now, mid to late 90s, where productivity was high, economy was strong, real wages were strong, inflation under control, and the Fed was able to cut. So that's kind of a perfect scenario and potentially one we're in. But we did get construction spending last week as well, up 12 months in a row now. Manufacturing construction up over 60% year over year. Total construction up over 14% year over year. November revised higher. I mean, these are things that, again, just layer on the idea that, listen, we wouldn't be seeing construction like this, in our opinion, if this big bad recession that we keep hearing about was truly around the corner.
That's a good way to underline all this, right? Construction spending. You wouldn't be seeing that if we were anywhere close to a recession. I think that sort of underlines all of it.
Yeah, exactly. And I did see, I mentioned on X there about productivity, and somebody, I talked about, only 1% in the 70s weren't very productive versus other times. And somebody had a picture of Alice Cooper, the singer. He's clearly had one too many drinks, and he's sitting there just kind of with a drink, and it says, the 70s. If you remember it, you weren't there. I thought that was, I love Twitter. That's funny. That's all I'll share. Anyway, so if you were in the 70s, maybe you remember it. Maybe that's why they weren't so productive. They had a good time. Nonetheless, everybody, we see higher productivity. We don't see a recession. Stock market's flirting with all-time highs. Maybe there could be a little indigestion here over the coming weeks. Nothing to be overly concerned about. Fed is going to start cutting sooner than later. And like Sonu just laid out very, very nicely, we're in an income-driven cycle, which probably has a lot more life left to it on this economic front. So with all that, this was episode 71. I know Sonu has to get the kids to school. Let the good times roll. Sonu, I'll let you roll and get the kids to school. We have a guest next week. We're going to talk a little Bitcoin ETF. It's going to be a really good one next week as well. Haven't had a guest in a while, so that'll be fun to have a guest again. I don't have to listen to us talk so much. You can hear some others, some smarter people talk, which will be great. So with that, everybody have a great week, a good Super Bowl week. Enjoy the Super Bowl. Be safe. We'll see. And root for a blowout, I guess. There you go. Yeah. We'll see everybody next week. Take care. Bye-bye. Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.